Picture this clearly. It is Wednesday, February 4th, 2026. On the surface, it looks like an ordinary weekday. Traffic moves, offices open, screens flicker with meaningless market noise. But behind closed doors in Washington, the countdown is loud. 11 days remain. February 15th is the line. That is the moment financial privacy around precious metals officially disappears. Most people have no idea it is happening. They are distracted by sports headlines, social media arguments, and 5-minute price charts that mean nothing in the real world. Meanwhile, the entities that actually move markets are already gone. They are removing physical metal quietly, methodically, without urgency. Because urgency is for people who realize the rules changed too late. Right now, there is a dangerous illusion playing out. The price you see on your screen is not the market. It is a reflection of leverage, promises, and delay. What matters is what is happening in vaults, ports, refineries, and regulatory filings. And what happened last month changed everything. On January 14, 2026, a signature altered the structure of global silver pricing. Not temporarily, permanently. Section 232 of the Trade Expansion Act was invoked, and most people still think that means tariffs. That misunderstanding is costly. This was not about taxes. This was about control. Section 232 grants the executive branch authority to restrict imports deemed a threat to national security. Historically, that power was used sparingly. This time it was weaponized with precision. The mechanism chosen was not a tariff wall. It was a minimum import price. That distinction matters more than anything else you will hear about silver this year. A tariff still allows arbitrage. A minimum import price destroys it completely. Here is how the old system worked. If silver traded at $30 globally and rose to $35 domestically, traders moved metal across borders. That flow kept prices aligned. It enforced efficiency. That system is now gone. Under the new regime, imported silver cannot enter the United States unless it clears a government-defined floor price far above the global market. It does not matter what London trades. It does not matter what Shanghai trades. The bridge is burned. Arbitrage is dead. For domestic miners, this is protection on a historic scale. Mines that were previously uneconomic suddenly work. Inefficiency becomes profitable when the government guarantees your selling price. That is intentional. The objective is to force production back inside U.S. borders regardless of cost. The free market was sacrificed to secure supply, but for investors, this creates a split reality that most people are unprepared for. From this point forward, silver has two prices. One is the global paper price driven by futures, leverage, and speculative flows. The other is the domestic physical price, which reflects what it actually costs to acquire metal inside the U.S. firewall. The difference between those two numbers is the premium. And that premium is not stable. It is expanding. We have seen this exact process before. Aluminum followed this path. Uranium followed this path. Silver is simply next. The mistake many will make is confusing assets with equities. As soon as government protection was announced, promotional campaigns exploded. Junior mining stocks, obscure tickers, penny valuations. The pitch is simple. Strategic metal equals guaranteed riches. History says otherwise. When a resource becomes strategic, governments consolidate control. Small operators are absorbed, regulated, or erased. Shareholders rarely benefit. Dilution comes first. Acquisition comes later. Ownership disappears quietly. Physical metal is not a business. It does not dilute. It does not require management approval. It does not issue press releases. That distinction matters now more than ever. Institutions understand this difference, and their positioning proves it. The commitment of traders' data from late 2025 into early 2026 shows a complete inversion. The bullion banks that spent years shorting silver reversed course. JP Morgan, HSBC. The largest participants flipped net long. That did not happen by accident. They understood Section 232 was coming. They repositioned before the announcement. Why does this matter? Because it signals the end of cheap foreign supply. Silver from Mexico, Peru, and other exporters no longer flows freely. The world is fragmenting into geopolitical blocks. Friendly silver and hostile silver. The United States just made its decision. Metal outside the perimeter is either blocked or priced into irrelevance. That changes everything downstream. Now look at the leverage sitting on top of this broken system. The COMEX Futures Exchange is operating at extreme ratios. For every ounce of registered silver available for delivery, there are hundreds of paper claims trading against it. In a stable world, this works because most contracts settle in cash. But this is no longer a stable world. Import barriers force industrial users to source domestically. When that happens, paper promises are tested. If a major manufacturer needs silver and cannot import it cheaply, they must stand for delivery. That is the stress point. Vaults cannot satisfy mass delivery requests. Paper contracts cannot power solar panels. Atoms matter. The early warning signal is already visible. Backwardation is appearing. Immediate delivery commands a premium over future delivery. That is the market admitting scarcity exists right now, not later. This is the fracture. The pricing mechanism is no longer functioning as designed. Supply chains are politicized, banks have repositioned, and the system is being re-engineered in real time. If you hold paper exposure, you are trusting a structure that is actively being rewritten to prioritize domestic control over contract integrity. This is not theoretical, it is procedural, and the implications extend beyond economics. Control of supply leads to control of ownership. That path has been walked before. When empires exhaust financial flexibility, they turn inward. The playbook does not change. The rhyme is familiar. The difference this time is speed. To understand the risk, history matters. In 1980, the Hunt brothers attempted to corner silver. They used leverage. They used futures. When the price surged, the rules changed. Liquidation only. Margin hikes. Forced selling. The establishment survived. The outsiders were destroyed. In 2011, silver approached the same level. 5 margin hikes in 9 days ended the move. The lesson is consistent. The house always protects itself. But 2026 is different. This is not private actors challenging the system. This is the system itself, locking down supply. Section 232 functions as a silent liquidation order, not to crash prices, but to trap metal within jurisdictional borders. And beneath that lies a legal reality that few understand. Under the Uniform Commercial Code, specifically Article 8, most paper silver exposure does not represent ownership. It represents entitlement, beneficial ownership. In legal terms, that makes you an unsecured creditor. If the institution fails, your claim ranks behind derivatives, counterparties. This is not speculation. This is statutory law. Bank balance sheets are under strain. Commercial real estate losses are accelerating. Emergency meetings are not signs of strength. They are containment operations. Bail-ins are now policy. Depositors and unsecured creditors are recapitalization tools. Unallocated metal accounts fall into that category. In a failure, the metal becomes the bank's asset. Possession matters because title matters. This is why physical premiums are diverging from paper prices. Smart capital understands legal hierarchy. In systemic stress, possession overrides promises. That understanding is already reshaping the market. And it is only beginning. Now shift your focus eastward. China has been quietly accumulating silver for years. While Western paper markets suppressed prices, Beijing purchased physical metal relentlessly. They understand something most in the US still fail to grasp. Silver is not just a monetary relic. It is the backbone of modern industry. Militaries, solar grids, semiconductor plants, and AI data centers all depend on it. Beijing's strategy has been straightforward. Control the supply chain. Control the metal. Control the future. The US woke up late. Section 232 is their response. It is a defensive perimeter designed to ensure that American industry does not collapse if foreign supply is restricted. The reality is harsh. If China restricts exports, the US industrial base could be halted in months. Section 232 ensures that critical supply stays inside the country. It is a firewall, a hard stop, and a price floor, all rolled into one. On one side, you have geopolitical pressure, scarcity, and rising demand. On the other, domestic law and enforcement are actively reshaping the market. This dual force creates a floor for silver prices while simultaneously tightening access. You cannot trade your way out of this. You cannot arbitrage it. The rules are no longer in your favor. The last vestige of free market access is disappearing. Now consider industrial burn rates. Silver is not consumed in luxury goods or trivial applications anymore. It is the conductor of our technological civilization. Solar panels require silver paste for efficiency. Electric vehicles consume silver in contacts and connectors. AI data centers depend on silver in circuits to process trillions of calculations per second. And in almost all cases, the silver is consumed. It does not return. It is lost forever. Micro amounts vanish into landfills across India, Africa, and elsewhere. This is not hypothetical. This is happening in real time. The numbers are sobering. According to the Silver Institute, global markets have been in a structural deficit for 5 consecutive years. Cumulative shortages now exceed 820 million ounces. That is equivalent to wiping out an entire year of global production. The vaults in London and New York are bleeding. COMEX registered silver, the metal actually available for delivery, is at levels unseen in decades. This is the physical cliff, and we just drove straight off it. February 15th is the date to remember. Stricter reporting rules are coming. Transaction thresholds are lowered. This is not about taxation. It is surveillance. Authorities want to know where silver is, who holds it, and who moves it. Anonymity is being stripped from the market, one regulation at a time. Walk into a coin shop after the 15th and any meaningful purchase will be documented. Your privacy evaporates. This is the classic gate closure. On the ground, the market is reacting. Dealers report delays in restocking. Premiums are creeping higher. Buyback spreads are expanding aggressively. Demand from defense contractors is prioritized. When a Tomahawk missile is launched, roughly 500 ounces of silver are vaporized per salvo. That metal is gone. It will never return to the commercial market. This is not a theoretical threat. It is a structural reality. The hierarchy is unambiguous. First, military applications. Second, strategic industry. Third, banking systems. Last, retail investors. Section 232 ensures this flow. Domestic supply is directed toward national security, not portfolio growth. If you are holding paper or ETF exposure, you are effectively last in line. Physical possession becomes everything. The green energy transition compounds this problem. Governments worldwide mandate solar and wind adoption. Those mandates create a fixed industrial demand curve. Billions of ounces will be consumed over the next decade. Geological realities do not match political ambition. There simply is not enough accessible silver in the ground to satisfy projected industrial consumption. When unstoppable industrial demand meets immovable geological scarcity, prices will not merely rise, availability will vanish entirely. Between February 4th and February 15th, the market still retains a narrow window of fluidity. Industrial giants understand this. They bypass exchanges, negotiate directly with miners, and secure offtake agreements before metal even leaves the ground. Public access to inventory is being drained quietly but relentlessly. This is not a correction, it is a structural starvation event. The deficit is real, the demand inelastic, and the surveillance grid will soon enforce compliance. From a strategic standpoint, we are at the crossroads of three major risk factors: a fractured supply chain, a vulnerable banking system, and geopolitical tension that dictates metal allocation. There is no room for error. Unlike past cycles, the signals are data-driven and law-enforced. The probability of sudden extreme outcomes is high. Based on intelligence, three scenarios dominate the landscape for the next 6-12 months. Scenario A: bifurcation. The government successfully isolates the domestic market. COMEX prices are suppressed to maintain the illusion of stability, but the actual cost to acquire metal within the U.S. firewall diverges sharply. Spot silver could trade near $30 on paper, while physical premiums explode, potentially reaching 100% or more. Paper contracts represent illusion. Physical metal represents truth. Scenario B: paper collapse. Industrial demand triggers a force majeure on the exchanges. COMEX cannot deliver. Contracts are settled in cash. Anyone relying on silver as an inflation hedge finds themselves with currency that continues to depreciate. The metal is gone, and contracts are meaningless. This is the ultimate systemic rug pull. Risk exposure extends far beyond retail portfolios. Industrial continuity is threatened. Scenario C: nationalization light. Section 232 is fully operationalized. Authorities impose moratoriums on private holdings, mandate sales through state-approved channels, or enforce reporting that enables immediate price control. Privacy becomes paramount. Any holder of significant metal is visible to regulators and potentially subject to state intervention. This is why February 15th is the critical date. The government is building a visibility grid over the entire secondary market. The strategy for survival is clear. In a system structured to favor possession over promise, liquidity is defined by who can deliver, not who will pay. Counterparty exposure becomes a liability. Physical silver is insurance. Treat it as such. Paper contracts are tools for speculation, not preservation. Avoid promotional mining stocks unless you possess specific expertise. In a resource conflict, governments and institutions have priority. Retail investors occupy the bottom tier. This is not fear-mongering. It is operational intelligence. The data, the filings, the industrial burn rates, and the legal framework all align. Physical metal is finite. Domestic legal control is expanding, and geopolitical scarcity is accelerating. Premiums are the market's alarm bell. If you hold physical silver, you are hedging against the collapse of trust in counterparties and the systemic seizure of paper assets. Consider legal exposure again. Unallocated holdings, ETFs, and other financial derivatives are vulnerable. U.S. law under Article 8 prioritizes the bank's obligations over your claim. In a systemic event, your holdings become part of the bank's estate. Possession, verification, and jurisdictional separation are no longer optional, they are survival metrics. Meanwhile, Beijing's strategy continues. China is not only securing supply but also controlling refinement and processing capacity. Export restrictions and industrial prioritization reinforce scarcity. The U.S. reaction through Section 232 is defensive, but it also creates a domestic premium. The interplay between Eastern accumulation and Western containment defines price structure and supply accessibility. Industrial consumption remains relentless. Silver is consumed in renewable energy, electronics, defense, and AI infrastructure at rates that outpace replenishment. Recycled metal cannot meet demand. This structural deficit is irreversible in the short term. Vaults are being drained. February 15th is a checkpoint in a much larger cycle. Whoever is unprepared will face either inflated costs, restricted access, or legal exposure. At this point, every action by regulators, dealers, and industrial users carries amplified consequences. Reporting thresholds, import controls, and physical scarcity converge. The final effect is a closed-loop domestic system where price discovery is secondary to allocation control. Paper markets exist, but they are decoupled from physical reality. Forward-looking investors must recognize the divergence and act accordingly. The takeaway is unambiguous. February 15th is not merely a date. It is the operational reset of the U.S. silver market. Reporting rules enforce visibility. Section 232 enforces domestic supply prioritization. Industrial demand enforces consumption. Legal frameworks enforce control over paper exposure. Together, they form a systemic firewall that is about to redefine the rules for every participant. Understanding this, the strategy is simple. Prioritize possession, verify holdings, exit counterparty chains, and anticipate systemic allocation. Physical silver is a hedge against regulatory intervention, industrial scarcity, and legal ambiguity. Paper instruments are speculation vehicles, not preservation tools. Knowledge of the dates, burn rates, supply structure, and legal hierarchies is essential. Ignoring these factors is a calculated risk in a system structured to eliminate optionality. Now let us tie all threads together and examine the operational realities. The silver market is no longer a simple commodity exchange. It is a complex system of legal, industrial, and geopolitical levers all moving in tandem. February 15th is the deadline. After that, privacy and fluidity will be virtually gone. Every ounce you own, every position you hold will be traceable, regulated, and potentially diverted by authorities if the system deems it necessary. The choice is clear. Act before the net closes or accept that control is no longer in your hands. Industrial users, from defense contractors to tech giants, are now sourcing directly from mines, bypassing exchanges entirely. Offtake agreements are being signed, and metal is being reserved before it even reaches the refineries. This is not speculation. It is a deliberate preemption of market scarcity. Dealers across the country report tight inventories. Premiums continue to rise, and restocking delays are growing. This pattern is identical to every historical instance where government intervention intersected with structural scarcity. The only difference is speed. The acceleration of these events is unprecedented. Military applications remain the apex of consumption. Every Tomahawk missile, every precision-guided munition, consumes silver. Each launch removes hundreds of ounces from circulation. That metal does not return. It is destroyed in execution, leaving the industrial base to absorb the gap. Strategic reserves exist, but they are finite. As geopolitical tensions rise in multiple theaters, the demand for strategic silver will outpace supply quickly. The industrial market has little choice but to comply, and that compliance drives domestic premiums higher still. Green energy transitions amplify the pressure. Solar panels, electric vehicles, and energy storage systems require silver. Unlike gold or platinum, silver is consumed in these applications. The metal is not reusable at industrial scale. Every ounce deployed is an ounce removed permanently from potential market circulation. When combined with legal restrictions, industrial prioritization, and limited imports, the result is a perfect storm for availability crises. Spot prices on a screen become almost meaningless. The real price is defined by what you can get your hands on today, not what the futures claim will be delivered months from now. Now consider legal exposure again. Article 8 of the Uniform Commercial Code defines most paper silver holdings as security entitlements, not actual ownership. ETFs, unallocated accounts, and derivative positions are claims on the institution, not on the metal itself. In a systemic event, these assets can be seized, reallocated, or liquidated without your consent. Possession is the ultimate safeguard. If the bank or exchange fails, only the metal in your hand carries unambiguous title. Everything else becomes a liability. The bifurcation we discussed earlier is already underway. Paper prices may remain low or volatile. Premiums for physical delivery are rising. The market is signaling stress. Backwardation appears. The price for immediate delivery exceeds that of futures. This is a signal no investor should ignore. When supply is constrained and demand is inelastic, premiums expand faster than spot prices. Industrial actors and smart money are already positioning accordingly. Scenario analysis remains critical. Scenario A, bifurcation, sees the domestic market insulated. Paper markets remain manipulated for appearances, but physical costs rise dramatically. Investors relying solely on ETFs will be misled. Scenario B, paper collapse, occurs if industrial demand triggers a failure to deliver. COMEX settles in cash, leaving investors exposed to currency depreciation without access to metal. Scenario C, nationalization light, envisions regulatory controls on private holdings, effectively directing supply to strategic actors. All three scenarios place retail investors last in line. The operational risk is unavoidable. Liquidity in a crisis is not about how quickly you can sell. It is about access to trusted counterparties. In the current system, banks, industrial giants, and government contractors occupy privileged positions. Their contracts are pre-signed, their deliveries guaranteed. Public investors are at the tail of the queue. Holding paper contracts in this environment is akin to standing at the back of a line that may never move. Physical possession, verified and secure, is the only real protection. The countdown is now explicit. 11 days remain until the surveillance and reporting mechanisms fully activate. The regulatory net will make anonymity impossible. Any transaction above the new threshold will be documented. Authorities will know where metal is moving and who holds it. That knowledge allows regulatory and industrial actors to prioritize distribution. For the first time, paper market prices may reflect very little of the actual physical scarcity. The illusion of liquidity will be maintained artificially, while the underlying structural deficit expands unchecked. The implications extend beyond investment portfolios. Industrial continuity, defense readiness, and technological development all rely on silver. Disruptions in availability affect solar panel production, EV manufacturing, and semiconductor reliability. Every ounce that enters military applications is permanently removed from civilian or commercial supply chains. This is why the government's actions are not about speculation. They are about security strategy and supply prioritization. Legal, industrial, and geopolitical levers intersect to form a closed-loop system. The market is no longer free. Section 232, Reporting Rules, Industrial Prioritization and Consumption Patterns combine to create a domestic firewall around strategic silver. The old assumptions about price discovery, arbitrage, and counterparty reliability no longer apply. The market has been re-engineered around possession, priority, and compliance. From a practical standpoint, the strategy is straightforward. Possession over promises, verification over speculation, and preparation over reaction. Investors must recognize that paper, silver, and derivative exposure carry risks beyond market volatility. Legal frameworks, systemic bail-ins, and regulatory control create structural vulnerabilities. Physical metal, secured and verified, is insurance against systemic failure. Historical context reinforces this. The 1980 Hunt brothers' attempt to corner silver ended with regulatory intervention that wiped out leveraged positions. In 2011, margin hikes curtailed speculative gains. The lesson: the house always protects itself. 2026 differs in that the house is now the state, and the objective is domestic control, not price collapse. Strategic metal is being sequestered behind legal and geographic boundaries. Those outside that perimeter will face severe access constraints. Industrial demand continues to accelerate. Silver is consumed faster than it is mined. Recycling is insufficient to fill the gap. The structural deficit is growing. And February 15th marks a regulatory pivot. Smart industrial actors, governments, and banks are pre-positioned. Public investors are not. This asymmetry is intentional, systemic, and enforceable. Ignoring it carries real consequences. Finally, understand the interplay of scarcity, law, and geopolitics. The COMEX and London markets now represent paper abstractions of value. True value lies in physical possession. Price signals are distorted by regulatory intervention and institutional positioning. Only those holding verifiable, accessible metal can navigate the coming disruptions successfully. Everything else is an assumption waiting to be tested. The window for action is closing. 11 days separate the market today from a state of near total transparency and controlled allocation. Positions taken now, particularly in verified physical silver, will define access and survival for the next cycle. The system is moving deliberately. Regulatory thresholds are being lowered. Physical scarcity is growing. Industrial demand is unrelenting. Legal frameworks prioritize possession over entitlement. February 15th is the line in the sand. For anyone serious about preserving value, the message is unambiguous. Secure your metal, verify your holdings, exit the counterparty chain, and understand that paper exposure is a liability in a crisis. Industrial actors and governments are prioritizing themselves. The retail investor is at the end of the line. The system is no longer neutral. Preparation now determines your position later. This is not a forecast. It is operational intelligence. The structural deficit, legal vulnerability, and industrial consumption patterns are verifiable. Regulatory timelines are set. Geopolitical factors are accelerating. The convergence of these forces defines the immediate and midterm trajectory of silver pricing and availability. Physical metal is not an investment in paper. It is a claim on reality, the only currency that cannot be abstracted, manipulated, or reallocated by law. The conclusion is stark. February 15th represents a systemic reset. Section 232, Reporting Laws, Industrial Prioritization, and Physical Scarcity combine to redefine access and control. Premiums will diverge from paper prices. Physical metal will command its value, while ETFs and unallocated accounts may not. Legal and industrial realities outweigh price speculation. The operational window is shrinking. 11 days remain. Action is the only option. Trust the weight in your hand. Trust verified physical possession. Do not trust promises, paper, or regulatory assumptions. The system is being rebuilt to favor those with access and control, and to marginalize those relying on abstractions. History, law, and industrial physics all converge on this single point. February 15, 2026 is the threshold. After that, the rules of engagement are no longer negotiable. The countdown has begun. 11 days. Physical possession is survival. Paper is illusion. The market is no longer free. It is a controlled environment. Your move determines everything.